Okay, so in the investing world, there's a premise that you would assume like money managers can figure out how to beat the market somehow. But uh, as we can see here in this article, beating the market is simple but not easy from Forbes. And there's a lot of articles like this. I just frankly just Googled and found um, a simple one that referenced a couple of different research studies. But most money managers suck at beating the market. So, for instance, there's this research found that over 20 years, ending in the end of 2019, the average equity fund investor underperformed the market by nearly 2% annually. And so when you get up to a cumulative amount for 20 years, that's 30%, which is quite bad. And also, 89% of domestic equity funds and 65% of institutional separate accounts underperform their benchmarks net of fees. So that's pretty bad. Less than 2% of managers generate outperformance beyond their fees. Also bad. And then we have a study by Vanguard that found that 18% of active mutual fund managers beat their benchmarks over a 15-year period. So that's a pretty short period. But yeah, so given that, 82% of active fund managers do not beat their benchmarks over a 15-year period, which seems to imply that beating the benchmark is difficult. But it's not. Basically, you just have to understand simple rebalancing. It's not brain surgery. I don't understand why this isn't a bigger deal. So, yeah, so the way for, me and you, normal everyday investors, to beat all the, or not all, but the vast majority of the hedge funds, the vast majority of the mutual funds, it's a pretty simple premise. You just rebalance between a few different assets. So, yeah, not that hard. So, for instance, to do that and just demonstrate how it works, you can go to this website called Portfolio Visualizer, and there they allow you to backtest different portfolio asset class allocations. So I'm setting up the simulation. You can, input the same things, you'll get the same result. So starting at 1972, which is the farthest it goes back, and in 2021, which is when I'm filming this, I'm saying the initial amount is $10,000, no additional cash flows, rebalance monthly. I'm putting up the benchmark, the S&P 500. Then I'm also creating a second benchmark, frankly, that is the total US stock market, which we see here. Asset one, US stock market, 100% of the portfolio one. And then the second portfolio, I'm just naming it rebalancing. It's extraordinarily simple. Basically, a third of your money, well, a third of portfolio two's money, which is titled rebalancing. A third of it is in large cap, a third of it in mid cap, and a third in small cap. So that's it. We don't know. We haven't done any analysis, right? Or very, very little. But the point is, you're just diversifying across these and rebalancing per month. And so by doing that, whenever, like, let's say for 1 month, large cap outperforms mid cap a little bit, but we have the expectation that both of these are good, solid investments that we're going to hold until we hit retirement. And so do that, we're going to make sure if U.S. large caps go up, and let's say, like in this scenario, we expect them, or every month we'll rebalance this back down to 33.4%. And that's just so I can get it to 100%. So the 0.4 versus the 0.3. But regardless, so let's say these large caps, they go up and maybe it gets up to 35% or something of our total portfolio because large cap did so well. And let's say mid cap didn't do so great, so it's a little bit lower than 33%. So at the end of the month, we're going to rebalance because large cap performed well, so it's overweighted. We'd go ahead and sell some of that, and we'd buy some mid cap to just rebalance it. And that's it. That's the whole premise. And so if that's all you did and all you ever knew, and you spent like 30 minutes a month rebalancing, then you come down, and so here's our two benchmarks. First, we got the total US stock market. That would have turned $10,000 into 1.4 million, which is, pretty sweet. The Vanguard 500. So this is just a way to look at the S&P 500. That would have turned 10,000 into 1.3 million, which is also, quite good. But if you spent the extra time rebalancing, you'd have 2.1 million, which is significantly better. So you can make like $700,000 over 50 years by simply rebalancing. And yeah, it's not that hard. And I just want to point out, so it'll only make about 1% more per year, but that adds up to a lot of money. I'm going to get rid of the logarithmic scale here. That ends up being a lot of money when you go over 50 years. So anyway, that's how you beat the total stock market and the S&P 500. And despite the fact that most mutual fund managers and hedge funds and everybody else who happens to be on Wall Street, despite the fact that they can't do it, we just did it. So yeah, hope you learned something from that. And yeah, don't be afraid to go ahead and manage your own money. And you can buy these things. I would just encourage you to go ahead and get some index funds to replicate these asset classes. But yeah, index funds, not actively managed funds.